Good afternoon, everyone, and welcome back. This is Daily Trading Analysis with a quick market update for today, Friday, May 26th. I know today is a pretty good day for bulls and pretty frustrating day for bears. I know you have been trading a lot today, trying to either jumping on this hyper trend to the upside on the market or trying to step in front of this huge trend that is the Nasdaq and the S&Ps, trying to short or even fade this market. I know because I tried to do that and I failed. But I have certain data to share with you, and I would like for you to be patient and to bear with me just 10 minutes. Because if you are bull, you need to hear what I'm trying to explain here. And if you're a bear, you really need to trust your instincts. Let's first start with economic data. And let me tell you, PCE is not good. PCE price index month over month came 0.4, way higher than the 0.1 the previous one. Year over year, 4.4, higher than the 4.2. Forecast was 4.1. For the month over month, 0.2. So this is already showing signs of the preferred measure of inflation from the Feds still going higher, way higher than expected. Core PCE price index month over month 0.4. We were expecting 0.3 as before, and still going higher, way higher than expected. And more than that, personal spending 0.8, doubled than expected, and income 0.4 as expected, but higher than before. So all this information tell you that inflation is not going anywhere. If any, it's accelerating. And not only that, we have a lot of people spending more and a lot of people gaining more. So what do you think they are going to do? They will keep spending to keep up with their lifestyles, to be on more debt, credit card debt, to keep up with the higher pricing that all these corporate people, businesses are just putting. Exaggerated and extended prices that people are continuously paying, willingly or not. So this is just the situation for today. This is the data. These are facts. And that is why, if you check the CME Group FedWatch tool, you can see that 60% of probability for a new 25 basis point interest rate hike. 1 week ago, we were at 17.4, and now we are 60.7. So, believe it or not, professionals, analysts, economists, the people that are most probably smarter than you and me, are already seeing bad news. So why is the market going up? Why is the market doing these insane things? Well, it's just two words: corporate greed. Corporate greed. The stock market is not the real economy. The bonds market are the ones trading risk. And these guys are freaking out. These guys are pricing in September 5.30 interest rates, and on December 5%. And let me tell you, they are not the only ones freaking out. Let me show you why you don't have to trust the markets in this situation in which we are receiving so much data that are contrarian to the stock market that is insane, that people keep buying at these prices. Some statements from the Fed. First, debt limit increase, no progress. There's absolutely no progress on these negotiations, these key negotiations. And if we get the deal, that doesn't mean that markets will like it. There might be some points on the deal that are not good for the economy. But let's focus on what Fed Mester said. Everything is on the table for the June FOMC. They can continue hiking, they can pause, and I don't think they are going to cut. Nowhere near this year. The Fed must look at all the data that's coming in. Well, if they see the data, they are not happy. I still support a Fed funds rate over 5%. So this is key. Fedmaster sees no cuts. It is important that the Fed doesn't under-tighten monetary policy. They did that in the past. They trust the markets and they started cutting interest rates earlier, and then inflation went up again. So they had to again hike and then control inflation. They don't want to repeat this issue. They don't want to do that again. Today's data suggests the Fed has more work to do. Fedmaster already saying more work, more hikes. Core services, excluding housing, inflation remains stubborn. Core services, the things that you and I pay. And Fedmaster's path for the funds rate is raise and then hold for a time. So these are the real news. These are the situation right now. Believe it or not, if you don't like them, that's your problem. But these are the situation. And more than that, IMF, International Monetary Fund, sees the Fed funds rate at 525 to 550 until late 2024. That is basically 1 year and a half from now. So we are going to be at these insane levels for way more time than people is expecting. Way more time. And are you able to think the kind of pain that is going to cause into everyone's economy? But these guys, the stock market, that just they just don't care. They only care about shareholder value. And right now, we are just buying on FOMO and on AI hype, trusting that tech is going to have good value in the short and mid-term. There's no way that in the situation in which we are right now in the economy, these guys are going to hold these values. And let me tell you, sooner or later, there's going to be a correction, and most probably these guys will take money from the central banks, and you are going to realize the bad decision that you are doing buying at these levels with the situation in which the economy is heading right now. Maybe you are hearing this and you say, you are a bear, you are just bad. Well, stock market is not the real economy. I understand that. I already buy here. I am a day trader. But if you are looking for investing, if you are looking to your 401k, your IRA, if you are actually buying Apple at these levels, Microsoft at these levels, let me tell you, and this is a fact, you are not taking good decisions based on risk versus reward. I'm just saying that. I'm saying that this hyperinflation, this corporate greed, the prices that you are seeing in the shops, the debt that you have right now for mortgage and for credit card debt, and all the rest of the things that you are feeling deep inside yourself that are not correct are not this. This is not the real economy. If you have to follow something, just follow the bonds market that are really, really managing the risk, and basically they are freaking out. So apart from this fundamental analysis, there's nothing more than just buy here, just buy here, or buy here, or buy here, or buy here, or buy here. I mean, you can do this buy the dip mentality a lot of times, but at some point, if you really want to dedicate yourself to this day trading, investing, you have to be freaking out about all these hypes. Nasdaq on the 30-minute chart just destroyed every level that was in my chart. I understand that tech is riding a wave of AI, but just educate yourself in the tech bubble of the 2000s. This is just exactly the same. But on top of that, we are heading towards hyperinflation, recessionary environment, followed with credit card debt for a lot of peoples. So are you really happy buying up here? Do you think this is good? There's a lot of money on the sidelines. And when I say a lot of money, I'm saying trillions of dollars from hedge funds that are not taking part of this. Why? Because they are seeing forward PE ratios, they are seeing balance sheets, they are seeing outlooks. And all these guys, not only on the Nasdaq, well, mainly on the Nasdaq, will not be able to hold these levels. Tesla is up 7% on not news. Apple is basically at these levels of March last year, in which every investor will take profits up here. There's no way the big players are buying up here. You are the only one. You, retailer, are the only one that is hyping on this stock to go to the moon. Buy the dip to the moon. Stocks always go up. This is such a bad investment. There is no way we are going to be able to just be at these levels for the amount of time that Feds and economists are saying we are going to feel the pain. That's between 2 to 4 years. Do you think Apple is going to be at these levels forever? I don't know if these are the lows, or any Nasdaq or S&Ps, these are the lows, probably. But buying up here is going against any risk management that you need to take into consideration to really have a career in these markets. Because then you will learn a lot of lessons that I already learned. And one thing is day trading, and another thing is just buying Amazon at resistance, Google at resistance, Nvidia at all-time highs. Do you think this is good in terms of value? Meta is entering this huge gap of almost $100 value. So basically, maybe this is a rant, but I'm trying to explain to you why today's price action is one of the worst things that it could happen today. It is fueled by FOMO, it is fueled by hype, it is fueled by the worst things that all these corporate businesses think and do. And I'm just trying to tell you that this is a bad investment. If you are doing trading, and you think you are doing a great job, be careful, because at some point you will learn hard lessons if you always do the same. Buying the dip, just buying zero DTE, gambling. And I'm not just, I'm frustrated because every day we we are seeing this price action without any kind of sense. And at some point, I'm just sitting tight. I'm not participating, but this kind of market is teaching a lot of people nothing about risk management and nothing about a real economy. And they will be destroyed, demolished in the blink of an eye. And I'm just trying to educate a lot of you to trade consistency and with profitability these markets. I'm not doing AMC hype, AI hype, Nvidia buy the dip. I'm trying to educate yourself with fundamentals and with facts to teach you how to trade these markets, to try to explain you why dollar is pushing in the green. Look at this. Why dollar is pushing and markets should not like this. Why yields are pushing and markets should not like this. Why interest rates are expected to be huge by the end of the year. Markets should not like this. Why gold is just being demolished because it hates interest rate, and markets should not go up. Why copper and silver are showing you overall slowdown on the economy, while all these markets are just breaking new highs and going on FOMO. I'm just trying to save you money by educating about the markets, about all these markets. And there's a lot of traps, a lot of big players that are playing against you. And this is just such a bad situation for you, and such a bad environment for you to really learn about this, because this is the definition of a big tech bubble. And we all know how it ended up in the 2000s. Interesting things about this, apart from the fundamentals and all the markets that I show you, Russell is in the green, but let me tell you, it's just in the middle of nowhere land. It was rejected. So why are we on a hype mode on tech? Bitcoin is just trying to, well, it's retesting basically support, and it's not looking good. Gold is just going lower. Dollar is preparing to continue higher after breaking this pivot and towards 105. Being strength in the dollar might show weakness in the Nasdaq and the S&P. Let me show you two charts. This is RSP. This is the S&P 500 equal weighted ETF. Do you think this is something like the real S&Ps? Well, we are still in range, but if all the stocks in the S&P were equally weighted, this is how it would look like in the chart. And more than that, look at this. This is the stocks, the percent of stocks about 200-day moving average in the entire market. While Nasdaq is destroying levels to the upside, 1, 2, 3, 4, 5, 6, 7 stocks in the entire US market are riding a huge way up. The rest of the market is doing new lows with only 37% of stocks being above the 200. This is called breadth, and this shows you that a huge amount of stocks are not even near the level of overvaluation that all these stocks have. So basically, in summary, I'm trying to explain to you why thinking in the long term that these guys are going to still continue pushing higher is just naive. I'm just trying to explain you how these markets are all pointing to the downside, while a bunch of bad guys jumped it and AI are riding the AI hype wave, and everyone is following them. And because they have such a huge market cap and weight in the overall market, this is just having extraordinary divergences in other markets. If you have to learn something today, just learn that forward PE ratio, that is the forward value of all these stocks and the outlook of all these tech stocks, are ultra high. And investors, big hedge funds, are not taking part at these levels because for them, they are overvalued. Who are the ones buying here? Retailers. The ones that when everything starts pulling back, they will just they will be destroyed and demolished until all other players that have been on the sideline with trillions of dollars start getting in, and you will be left with a facepalm and saying, I trust these huge tech companies, and you basically are doing poorly decisions up here. Poorly. Do you think this is safe? That's my question. So I think that's all from my side. Sorry for my rant. I hope you learned something today from me, from my point of view, and if you just reach this point of the video, just thank you. Thank you to be here and listen to me, because I'm really trying to and putting a lot of effort to trying to educate everyone on these markets, because I've seen such a big things on these markets that this is one of the things that this is unbelievable. I cannot understand why people nowadays are taking so poor decisions with their money. But well, it is what it is. Facts are there, fundamentals are there. I will be waiting for my opportunity to just trade what I think is the best move from now on. Thank you for your time. As always, if you found this video useful, please remember to click the like button and subscribe to the channel to receive notifications when I upload new videos. Remember that I upload new videos every single day for market forecasts, market updates, and market recaps. I appreciate your time as always. If you were long today, congratulations again, but please watch out, because we are ahead of a 3-day long weekend, and there will be a lot of people taking profits into the afternoon. So be really careful and just enjoy your long weekend. Thank you for being there, and remember that, as always, discipline and risk management are key for your success. Stay safe, everyone, and see you on Tuesday.